Hello, everybody, and welcome back to Chapter 4. In this chapter, we're going to be taking a look at the balance sheet and the statement of statement of cash flows. A lot of this chapter, I think, will be review, but a lot of it will build on what you already know. So, with no further ado, we'll move on. Our learning objectives are we're going to take a look at the uses of the balance sheet, but also some of its limitations, and maybe a little more expansion of what the content of those balance sheets include. And we'll explain how we do the same thing for our statement of cash flows. So just previewing for a second here, we're going to look at the usefulness of the balance sheet, its limitations, how we classify items in the balance sheet, and its format. And the same kind of thing for our statement of cash flow. What's its purpose? What's the content? How we prepare it, and how we use it. All right, let's take a look at in a little more depth here. Sometimes we call the balance sheet a statement of financial position. Just another name for the balance sheet. I rarely use that terminology, but you might see it in the literature sometimes. Okay, it's going to report our assets, liabilities, and equity at a specific date. It provides information about resources, and those include obligations to creditors and equity in net resources to our owners. It helps us predict the amounts, timing, and uncertainty of cash flows. Investors want to know how cash flows flow so they can determine if the company is worthy of their investment. Okay, and we're going to look at how we compute rates of return, evaluate our capital structure, assess risk and future cash flows, and just generally analyze the company's liquidity, solvency, and for that matter, its financial flexibility. All right, so we have two general issues we want to go through in the chapter, liquidity and solvency. And you've heard those terms before, but liquidity describes the amount of time that it takes to convert our assets into cash, or our liabilities that need to be paid. Solvency refers to the ability of the company to pay its debts as they mature. So the focus here is on long-term viability of the company. So we will take a look at that in a little more depth here. So liquidity and solvency. So the way I remember that term solvency, by the way, is that if a company is insolvent, it's bankrupt. But if it's solvent, it's proceeding nicely, being profitable. Okay, so it's going to affect liquidity and solvency will affect a company's financial flexibility. And their definition here is the ability of an enterprise to take effective actions to alter the amounts and timing of cash flows so it can respond to unexpected needs and opportunities. A very nice description. So as it says here, a company may become so loaded with debt, so financially inflexible, that it has little or no sources of cash to finance expansion or pay off maturing debt. So the more The high degree of financial flexibility means that it's going to be able to survive bad times, weather the storm, if you will, and take advantage of profitable investment opportunities. Okay, so the higher the company's financial flexibility, the lower its risk of failure. So, we'll move on. Most assets and liabilities are reported at historical cost. So, of course, our balance sheet is not going to be reflecting the fair value of those assets and liabilities. So, and also, some of those assets and liabilities require using judgment and estimates. And reasonable people sometimes can disagree on what those judgments and estimates are. Many items of the financial value are omitted if they can't be recorded objectively. You'd have to dig through the notes to financial statements if it's full disclosure is provided to see what those items are. Okay, classifying the balance sheet. Elements of the balance sheet. First of all, of course, we have our assets, and they have a lovely definition here of that. Probable future economic benefits obtained or controlled by a particular entity as a result of past transactions or events. And liabilities is the same kind of definition, except they are probable future sacrifices of economic benefits. Okay, so equity then represents the residual interest in assets after deducting liabilities. In a business enterprise, that equity is viewed as ownership interest. So I think you can see from a big picture standpoint, assets, the liability represents outsiders' claims on our assets, whereas equity represents the owner's claims on those assets. Okay, let's look at how we're going to classify that balance sheet. Here they show you the assets, and we divide that into these categories as shown here. And liabilities, we do the same thing. We take current liabilities, long-term debt, and then owner's equity. And owner's equity is comprised of common stock generally and retained earnings. So in practice, you see very little departure from these major subdivisions. And again, we never debit and credit those subdivisions. We debit and credit the general ledger accounts within those subdivisions. Okay, so cash and other assets a company expects to convert into cash, sell, or consume either in 1 year or in the operating cycle, whichever is longer, is the definition of current assets, right? So here they are. We have cash and cash equivalents, short-term investments, receivables, inventory, and prepaids. And our cash naturally is set at fair value, meaning that whatever cash we have is stated at that value. Our short-term investments generally are the same thing. Receivables are estimated at what we think we can collect. You'll remember the allowance for doubtful accounts is subtracted from receivables to get to net receivables. And then in inventory, we use a lower of cost or market or net realizable value or market to determine what our inventory is reflected at on the balance sheet. And then prepaid expenses generally are reflected at what it costs us for that. Okay, cash. Generally, cash is any monies that are available on demand. Our checking account, basically. Cash equivalents are short-term, highly liquid investments that mature within 3 months or less. When I, as the chief financial officer, feel that I have more cash than I can use in a given month or so, I'll invest those in these highly liquid investments so that I get some interest on it. I, for one, never do it for more than a month, but here the definition is 3 months or less for a cash equivalent. And you can find that these short-term investments don't vary any, or if so, very, very little from what we invest in, like putting money in a bank account. And of course, any restrictions or commitments must also be disclosed. Now, here is the Walt Disney Company and how they've presented their cash and cash equivalents, other current assets, and their other assets in total here. Now, they have a note that shows how they came up with this this note to show how they came up with the restrictions here. We have restricted cash is included in our other current assets and other assets. And so our total cash, cash equivalents, and restricted cash are 54.55. But we are going to show 54.18 in our current asset reporting on the balance sheet. Okay, short-term investments. All equity securities are recorded at their fair value, with changes reported in net income, unless they're accounted for under the equity method or it's not practical to determine the fair value. So, short-term investments here, we have 3 separate classifications of debt securities: held to maturity, trading, and available for sale. Held to maturity means the company has a positive intent, their intentions are, and the ability to hold that investment until they mature. Trading securities, debt securities, they're bought and held primarily for sale in the near term. We're looking to generate some income or short-term price differences. And then we have our available for sale. They're not classified as held to maturity or trading securities. Okay. So if I look at this, short-term investments, the balance sheet presentations, here's our cash, cash equivalents, and our short-term investments, current asset. And then they have a note that shows that we have debt securities available for sale and a mortgage loan. So they split this 2373 into its 2 pieces here. Okay, and we carry that at fair value. And here are major categories of receivables should be shown in the balance sheet or on related notes. So we should clearly identify anticipated losses due to uncollectibles, the amount and nature of any non-trade receivables, and receivables used as collateral. That looks like a good place to stop our first video. And when we return, we will take a look at receivables in more depth. Until then, bye for now.